Hi everyone! In today's video, we'll be taking a closer look at a company called Agree Realty. Agree Realty, founded in 1971, is a real estate investment trust that focuses on owning and managing retail properties leased to national tenants across the United States. The company's portfolio includes freestanding stores and shopping centers occupied by grocery stores, pharmacies, home improvement chains, and other essential retailers like Walmart, Lowe's, and Dollar General. Agree Realty earns revenue primarily through long-term lease agreements with tenants in recession-resistant industries. The company's portfolio is diversified across various retail sectors, focusing on tenants with strong credit profiles. Notably, 68% of its tenants are investment-grade rated, underscoring the quality and stability of its rental income streams. Agree Realty's extensive and diversified portfolio, coupled with its focus on high-quality tenants and consistent financial performance, positions it as a significant player in the net lease retail property sector. ADC's three-pronged growth strategy, focusing on providing real estate solutions for leading retailers. The strategy is built on three pillars: acquisitions, acquiring properties leased to top-tier retailers; development, building new properties to meet tenant needs; developer funding platform, supporting third-party developers through funding opportunities. At the foundation of this strategy are retailer relationships, which emphasize constant communication to understand tenant performance and sustainability while identifying risk-adjusted opportunities. ADC's investments, addressing the evolving retail landscape. Omnichannel critical, focus on e-commerce resistant sectors and mature omnichannel operators. Recession resistance, balanced portfolio exposure to counter-cyclical sectors and creditworthy retailers. Avoidance of private equity sponsorship, prioritizing operators with strong balance sheets and avoiding private equity-backed retailers. Strong real estate fundamentals, investing in adaptable buildings to handle market shifts effectively. Agree Realty will pay a dividend of $3.04 over the next 12 months, distributed monthly, with the next payment scheduled for February 14. The current dividend yield is 4.19%, which is considered average for Agree Realty. The price-to-AFFO ratio is 17, also in the average range. The most recent dividend increase was 1.2%, which isn't very high. Personally, I prefer a minimum annual growth rate of 4%, which has been the average over the last 5 years. The payout ratio is at healthy levels and is showing a decreasing trend. Both FFO and free cash flow per share are showing stable growth. The company's debt levels are currently in good shape, and if the expected Fed rate cuts occur, this could further improve the situation. The company appears to be reasonably priced at the moment, but long-term investors may want to keep an eye on the company and potentially open a position now for the passive income that comes with the monthly dividend. In summary, the payout ratio meets expectations. The dividend yield is currently above 4%, and the 5-year average growth rate is well above 4%. The company's debt levels appear to be healthy. Long-term investors may want to consider purchasing. Disclaimer: this video does not constitute investment advice. Do not make decisions based solely on the content of this video. Always do your own research to determine whether a company aligns with your investment strategy and portfolio. Whether you're an investor, industry enthusiast, or just someone curious about emerging trends, this video is your go-to guide for understanding VICI's potential. VICI Properties was created in 2017 when Caesars Entertainment spun off some of its real estate assets. The real estate investment trust primarily owns casinos, with a significant portion of its rent coming from its properties on the Las Vegas Strip like Caesars Palace, Mandalay Bay, and the Venetian. VICI acts solely as a landlord to its casino operator tenants, who are responsible for paying property maintenance expenses, taxes, and insurance. The REIT's portfolio also includes other experiential properties, such as water parks, bowling alleys, and arcades. Over the past year, it has underperformed the S&P 500, which is why we'll take a closer look to see if the company might be undervalued. Expected price and various ratios suggest the company appears to be slightly undervalued. The payout ratio seems to remain within a healthy range even in the long term. Both FFO, funds from operations, and free cash flow per share have been growing year over year, which is a very important indicator. Debt levels appear to be slightly high, but the chart shows a declining trend over the years. If the company continues this trend, it could reduce its debt to the desired level within a few years. The annual dividend is $1.73, which the company pays in 4 quarterly installments. The next payment is scheduled for April 4th. The dividend growth rate is not particularly high. My personal minimum expectation is a 4% annual increase, especially for companies offering a high initial dividend yield. For now, the dividend seems sustainable, provided the company can maintain its planned growth trajectory. VICI's long-term strategy aims to provide solutions to its partners' needs both in the present and in the future. The strategy is built on 3 main pillars: real estate acquisitions, growth fund, and credit solutions. Real estate acquisitions. Acquire irreplaceable, mission-critical, non-commodity real estate offering place-based, scaled leisure and hospitality experiences in a triple net lease structure with industry-leading operators. VICI Partner Property Growth Fund. Work collaboratively with existing tenants and partners to invest in growth opportunities across real estate developments and capital improvements that achieve mutually beneficial outcomes. VICI Experiential Credit Solutions. Creatively provide debt capital to new and existing partners across experiential sectors that generates attractive returns and builds a strategic path towards potential future real estate ownership. VICI's investment strategy aims to increase shareholder returns. The strategy is built on 3 main pillars: external growth, same-store rent growth, and dividend yield. External growth. The company aims for sustainable AFFO growth through real estate acquisitions, growth fund strategies, and credit solutions. Same-store rent growth. A 1.7% rent growth driven by minimum contractual annual rent escalations, complemented by CPI-linked rent increases. Dividend yield. A 5.5% dividend yield supported by annual dividend increases since the IPO. In the current economic situation, companies similar to VICI generally do not perform the best, primarily due to high interest rates. Before summarizing the points from the video, I thought it was important to mention this. Summary. Payout ratio. The payout ratio is below the expected 75% level, and it looks like they will be able to maintain this next year as well. Debt. Currently, it seems somewhat high, but the trend is improving, and the expected interest rate cuts within the next year could provide additional support. Dividend. VICI offers a well-established high initial dividend yield, with growth above 4%. Dividend safety. There is currently no indication that the dividend is in significant danger, and the outlook for next year is promising. Overall, the company seems to be slightly undervalued, making it worth considering for any investor. In this video, we'll be taking a deep dive into NNN REIT. If you enjoy the content, please show your support by leaving a like and subscribing to the channel. And don't forget to drop a comment about which company you'd like me to analyze next. To make things easier, I've created a table summarizing the key information and financial metrics of the company. This will make the analysis more accessible, even for those who are new to investing. Let's start with the basics. Full name, NNN REIT, Inc. Ticker, founded 1984. Headquarters, Orlando, Florida, United States. Market focus, automotive service, convenience stores, family entertainment. Portfolio overview. Location of properties, United States. Occupancy rate, 99.3%. This is a crucial metric for REITs. If their properties are not leased or tenants fail to pay, it can create significant challenges for the company. A prime example of this is the struggles faced by Medical Properties Trust in recent times. Financial performance. Revenue, $867.2 million. The company has shown stable revenue growth compared to previous years. Net operating income, $395.162 million. Again, we see steady growth. However, there hasn't been much change between 2023 and the most recent 12 months. Every company experiences occasional slower years, and later in this video, we'll uncover why 2024 turned out the way it did. Funds from operations, per share, This is another vital financial metric for REITs. While overall FFO growth is important, the per-share FFO must also increase. REITs regularly issue new shares, which can dilute returns. If you know why REITs issue shares, let me know in the comments. Or if you'd like a summary video about REITs, feel free to request one. Dividend yield, 6.11%. This is considered a high starting yield, even among REITs. While dividend growth is not dramatic, that's to be expected with such a high initial yield. The key takeaway is that they've managed to increase their dividend for 36 consecutive years, and their FFO payout ratio is well within safe limits. Debt metrics. Metrics such as net debt to EBITDA, net debt to capital, and interest coverage meet expectations, ensuring that the dividend appears sustainable. If you'd like a detailed breakdown of these financial metrics, let me know in the comments. Valuation. The expected price is estimated between $41 and $50, which, combined with the above metrics, suggests the stock might be undervalued. Growth and strategy. Acquisitions and dispositions. Invested $113.6 million in property acquisitions, achieving a 7.6% initial cash cap rate with an average lease term of 18 years. Sold 9 properties for $20 million, generating $7.8 million in gains at a cap rate of 4.4%. Long-term growth strategy. Focus on single-tenant net lease retail properties. Operate with a multi-year strategy aimed at improving per-share results. Maintain high occupancy rates and maximize the value of existing assets. Diversify the portfolio further. Grow through internal portfolio improvements and well-analyzed acquisitions. Use asset sales to manage risk and partially finance new investments. Preserve financial flexibility with conservative debt management. Target mid-single-digit growth in per-share results annually. Continue to produce safe and growing dividends with 35 consecutive annual increases. Market conditions. In today's high inflation, high interest rate environment, it's essential to understand how these macroeconomic trends affect REITs and their stock prices. Inflation. While inflation can boost REIT revenues through higher rents and asset appreciation. Interest rates. Rising rates can increase debt costs and reduce investor demand for REIT shares. Diversified REITs like NNN, with long-term leases and stable tenants, are typically better positioned to navigate such challenges. Why didn't 2024 go well for NNN? As we discussed earlier, high interest rates negatively impact REITs, including NNN. This creates headwinds for growth and financial performance. The other reason for the significant drop in the stock price will be mentioned below, and while you're there, feel free to leave a comment about whether you found any useful information in the video. Why NNN might be a good buy for conservative investors. After the Federal Reserve announced a pause in rate hikes, possibly influenced by Trump's economic policies, NNN stock saw a sharp drop. I believe the market overreacted. Historically, it's been a good strategy to start accumulating such stocks 6 to 12 months before rate cuts. Additionally, the U.S. economy still has room to accommodate higher rates, which makes the Fed's decision a prudent one. Final thoughts? Thank you for joining me as we explored this company together. Every step we take toward understanding investments is a step closer to achieving financial freedom. Let me know in the comments if you learned something valuable, and don't forget to like and subscribe. See you next time.